Revenue streams. Revenue streams are the different sources that a company makes money from when they sell goods and services. Different types of revenue are recorded based on the kinds of activities carried out by the company. Generally speaking, retail businesses have more diverse revenue accounts than businesses that provide services. Let's look at some of the different types of revenue. First, we have operating revenues and non-operating revenues. Operating revenues are proceeds that are earned from a business's core operations. Non-operating revenues are proceeds gained from side activities unrelated to its core business. For operating revenues, revenue from the sale of goods or services is the core revenue account for most businesses. For example, Coca-Cola's core operation is its sale of soft drinks, so the revenue from the sale of its goods is its core operating revenue account. Meanwhile, for non-operating revenue, there are several different types of revenue. There's interest revenue, which is interest earned on investments, rent revenue, which is the amount earned from renting out buildings or equipment, and dividend revenue, which is revenue gained from holding shares in other companies. On top of different types of revenue, there are also different revenue streams. Revenue streams categorize the earnings a business generates from different pricing mechanisms and channels. Some examples of different revenue models are transaction-based revenue, service revenue, project revenue, and recurring revenue. Transaction-based revenues are proceeds from the sale of goods that are usually one-time customer payments. These are usually regularly recurring transactions. The example used earlier with Coca-Cola is a good example of transaction-based revenue. Every time someone buys a bottle of cola, they pay for it in full and don't need to worry about paying again until they want another. Service revenues are generated by providing a service to a customer and are usually determined based on the amount of time used. For example, if you are hiring a consulting firm or a lawyer, they would charge you based on the number of billable hours they worked for you. Project revenues are earned through one-time projects with existing or new customers. Projects are usually significant and large tasks that take a long time to complete, like constructing a building, so revenues from this type of revenue stream tend to come in big chunks. Finally, recurring revenues are earnings from ongoing payments for continuing or after-sale services to customers. This model is very popular because of the predictability of cash flows and helps ensure that money will continue to flow in over time. Some examples of recurring revenue streams are subscription fees like Netflix and Spotify, rental fees, licensing fees for content, brokerage fees, and advertising fees. It's important to have a good understanding of revenue streams because revenue is one of the most important key performance indicators for any business. Financial analysts need to be able to discern between revenue streams and how much money they generate. As well, performance predictions depend on the type of revenue stream being evaluated. For example, recurring revenue provides consistent cash flow while transaction-based and service revenues fluctuate with demand. Project revenue is even more volatile because it depends on client relationships. Finally, different forecasting models need to be used depending on what revenue stream an analyst is evaluating. A recurring revenue forecast model should have a uniform structure and a consistent prediction pattern, while a project-based revenue model needs to be continuously monitored for project opportunities. We hope this video was able to help you grasp a better understanding of revenue streams.